And welcome to this afternoon's webinar titled Inheritance Tax and Pension Planning Explained. This webinar has been run by me. I'm James Phillips, and my colleague Charles Richards. IHT is complicated, and it's getting more complicated following the announcements in the budget last year. So from April 2026, it's getting more complicated for business owners and farm owners with the changes to business property relief and agricultural property relief. And then again, from April 2027, it's getting more complicated for those with personal pensions when those will fall into the estate for IHT purposes. Please don't expect to be an expert on this topic after this session. Our objective today is to pitch the content at a level that you're all going to be able to understand. And by the end of this session, you'll be able to work out what your IHT liability is and also understand some of the options in regards to mitigating this. Today's webinar is the second in a series of 4, and it follows my colleague's John Endicott's webinar at the start of the month, and that was titled IHT Relief and Succession Planning Overview. John's webinar focused on clients with businesses and changes to business property relief in April 2026. That content is still available via the link on our website if you missed it. Today's webinar is focused on IHT strategies to consider outside of restructuring ownership of a business or redrafting a will, and has a particular focus around pensions. As you can see, there's 2 more webinars in this series that follow towards the end of this month, and they focus on the topics of business exit and rural succession planning. The famous quote on the slide is from the former Labour Chancellor Roy Jenkins. He said, "Inheritance tax is a voluntary levy paid by those who distrust their heirs more than they dislike the inland revenue." So what did he mean? Essentially, the point he's trying to make is that IHT is voluntary because you can mitigate it fully during your lifetime by giving enough assets away. However, it comes down to how much you trust the people you give those assets to give them back to you if you actually need them, versus how much you dislike paying IHT in the first place. As we go through today's webinar, it will be clear that it's important to provide flexibility in any IHT planning you undertake, so that whatever happens in the future, you don't leave yourself financially vulnerable should the unexpected arise. Before I run through the agenda, we just wanted to take a couple of minutes to introduce ourselves, because we probably haven't met all of you previously. So first of all, Charles, do you want to introduce yourself?
Yes, sure. So good afternoon, everyone. My name's Charles Richards. I'm a private client tax director at Francis Clark. I've been with the firm for over 10 years and I trained at Francis Clark as well. I'm a chartered accountant, a chartered tax advisor, and a trust and estates practitioner. I spend most of my time either in the extra office or the Torquay office and cover advice across all areas of private client tax. But I have a specialism in trust and estate planning, which has kept me particularly busy at the moment. And outside of work, I spend most of my time with my horses, and I'm still regularly competing in show jumping.
Well done. Thank you, Charles. So myself, I'm James Phillips, go by my initials JP commonly. I'm head of financial planning. I've been with the firm just over 7 years. As head of financial planning, that means I lead our financial planners. We've got 19 financial planners in the firm across all 9 offices. And I also look after a small client portfolio too. Outside of work, I live in Bournemouth, so I'm predominantly linked to our pool office. I'm married, I've got 2 daughters, and we have a new dog, a new puppy, who is keeping us all very busy. So in terms of the agenda, Charles and I will be sharing the content today. Going to run through, first of all, the introduction. Then we're going to run through how you calculate your estate's IHT liability. Then we're going to talk through the options to mitigate IHT, and the theme of pensions will run through those 2 individual middle parts there. And then we'll have some time for questions. We do have quite a large number of people on the webinar this afternoon, which is great. But rather than take questions as we go along, please add your questions to the Q&A tab. Hopefully you can see that on the side of your screen. And we'll look to cover the questions towards the end. There will be 2 polls as we go through the webinar to help you guys get involved in the webinar this afternoon. And finally, in terms of timing, we are hoping to take an hour and be done by 1 o'clock. Okay, so in terms of introduction, for those of you who are not financial planning clients of ours already, Francis Clark Financial Planning is part of the wider PKF Francis Clark firm. We're chartered, we're independent, and we pride ourselves on the joined up financial planning advice that we provide alongside experts like Charles and the rest of the tax planning team, and we provide that all under one roof. IHT planning commonly involves collaboration between clients and three elements. So tax advisors like Charles and the team are commonly needed for advice around structures, strategies, tax calculations. FP, so that's financial planners, that's me and my team. We're commonly required for cash flow planning, IHT financial planning solutions and the implementation of those solutions. And lawyers are commonly required for drafting wills, lasting powers of attorney, and trust deeds. Very rarely in our experience do clients solve an IHT issue all in one go. It's much more common for clients to take action over a number of years, different actions over a number of years to improve their situation. I'm now going to hand over to Charles to run through details of how you calculate your estate's IHT liability.
Thanks, JP. So yeah, as you mentioned, we're going to go through a sort of a bit of a pro forma of how to calculate your inheritance tax liability. This does assume a simple estate with straightforward wills, and it can be more complex. There are other issues you might have to consider. I know John mentioned in his previous webinar about things such as BPR spreading and grossing up and things like that. And if you do have any concerns or queries about calculating your inheritance tax liability, I would suggest speaking with a tax advisor, like myself, who can help you. So starting point is to look at the probate value or the market value of your assets at the point we pass away. And from that, we can deduct any liabilities at the time of your death. So that might include things such as a mortgage, credit card, any tax due, loans, things like that. So after that, we can deduct any exemptions and available reliefs. So some common exemptions are sort of gifts to charities, gifts to your spouse, and then also in terms of the reliefs, business property relief is obviously a key one we've been talking about recently, and agricultural property relief as well in respect of agricultural assets. So after that, we can then also deduct any available nil rate bands. Every individual has a nil rate band of £325,000. And for married couples, any unused nil rate band passes to the surviving spouse. This gives a potential nil rate band and transferable nil rate band of £650,000 between a married couple. It's worth noting that that nil rate band is reduced by any gifts made in the 7 years prior to death. The nil rate band has actually been the same since April 2009. However, from April 2017, the residence nil rate band was introduced. This is an additional nil rate band and is currently £175,000. Again, for married couples, any unused residence nil rate band on death passes to the surviving spouse. This gives a possible total residence nil rate band of £350,000. This is where the widely publicised £1 million threshold comes from. The £650,000 nil rate bands, the £350,000 residence nil rate bands. There are more conditions attached to the residence nil rate band. It only applies if you leave a residence to a direct descendant and is tapered for estates over £2 million. So the residence nil rate band is tapered by £1 for every £2 your estate exceeds £2 million. This means for a married couple where the survivor's estate exceeds £2.7 million, there is no residence nil rate band available. The other thing to bear in mind is that the residence nil rate band isn't impacted by any lifetime gifts. So once we've deducted those exemptions, the nil rate band, the residence nil rate band, inheritance tax is charged at 40% on that balancing amount. But this is reduced to 36%, where 10% of your net estate is left to charity. So another point to bear in mind is that in the autumn budget, the Chancellor announced that the inheritance tax thresholds will remain the same until 2030. Therefore, more people are going to be brought into the net of inheritance tax before even taking into account the changes that are coming in April 26 and April 27. So I thought it would be helpful to go through an example. So here we have on the next example, a married couple, Henry and Lorraine. They have mirror wills, which leave everything to the survivor and then to their children on second death. Again, to keep the calculation simple, I've assumed there's no gifts in the 7 years prior to death. Their assets include, as shown on the slide, £750,000 for their home, £500,000 for the rental property, £200,000 in cash, £300,000 in investments and ISAs, £50,000 of chattels, and they also have personal pensions, which is Henry £600,000, Lorraine £400,000. So if you add up all those assets, their total assets are 2.8 million. However, at the moment, most pensions are exempt from inheritance tax, and therefore the total value that we is subject to inheritance tax on death based on those assets is 1.8 million. So if we go on to the calculation, on the first death, so let's assume Henry passes away first and leaves everything to Lorraine. There'll be no inheritance tax at that point because it's entirely covered by the spousal exemption. On the second death, Lorraine has inherited all of Henry's assets, so her total estate will be that 1.8 million that's subject to inheritance tax. From that, we can deduct her nil rate band of £325,000, his nil rate band, which she's inherited from him as he hasn't used it. Their total estate is under the 2 million threshold, so there's no tapering of the residence nil rate band. So therefore, they qualify for the residence nil rate band of £175,000. And again, Henry hasn't used his, so inherits his residence nil rate band as well. So that gives a full £1 million of nil rate bands and £800,000 that's subject to inheritance tax at 40%. That gives a liability of 320,000. So if we look at the assets within their estate, that's relatively easy to be funded because they've got £200,000 in cash and £300,000 in investments and ISAs, so liquid investments that they can pay the inheritance tax from. The other point to bear in mind is the children would inherit the pensions free of any inheritance tax. This position is obviously going to change from April 2027 when their pension is going to become subject to inheritance tax. And now I thought it'd be helpful to hand you over to JP, who will go through the changes to inheritance tax on pensions in a bit more detail.
Thanks, Charles. So as Charles mentioned in the example, pension death benefits are currently exempt from IHT. As a result, loads of clients, loads of people have earmarked pension funds actually as the last asset to spend in retirement to meet income needs. And they've sensibly been using all other savings and investments in the first place, so left their pension funds to grow inheritance tax-free and spend down other assets in their estate. So in last year's budget, it was announced that from April 2027, pension death benefits will fall into the estate for IHT purposes. So as a result, many more estates will be liable for IHT. So this is a substantial change. These changes impact defined contribution pensions, which includes things like personal pensions, SIPs, employer-sponsored money purchase schemes. It does not impact defined benefit or final salary pensions. Government figures estimate that 10,500 estates each year from April 2027 will pay inheritance tax for the first time because of these changes, and 38,500 estates each year will pay more inheritance tax because of these changes. It's important to note that age 75 will remain an important milestone for pensions going forward when these changes come into effect from April 2027. So if we assume we scoot forward 18 months and we're already in April 2027, the rules are as follows. So if you're unfortunate to die before age 75, the pension fund value will fall into the estate for IHT purposes and will therefore be potentially liable for IHT at 40%. On top of that, if the value of the pension fund inflates the estate value to over £2 million, you'd start to lose some or all of the residence nil rate band, as described by Charles. The residual pension fund in that scenario is accessible by the beneficiaries with no income tax liability. If you die after age 75, I'm afraid to say it's even worse for tax purposes. Not only will the pension fund fall into your estate for IHT purposes and be potentially liable for IHT at 40%, And again, if the value of the pension fund inflates your estate over £2 million, you can start to lose some or all of the residence nil rate band. But in addition to that, the residual pension fund would be liable to income tax at the beneficiary's marginal rate of income tax, which is up to 45%. What this means is potentially it adds up to an effective rate of tax on the pension fund of up to 67%. Charles will now run through the previous example as if we've scooted forward and we're already in April 2027.
Thanks, JP. So again, looking at the example with Henry and Lorraine. So their total assets are 2.8 million. We now obviously include the pensions. The thing we've assumed with this calculation as well is that the pensions pass to the surviving spouse and then to the children. It's worth noting that the wills do not impact on how the pensions pass, and you'll need to consider the nomination form with the pension trustees or your expression of wishes in terms of setting out who those pension assets should pass to. If you do need any help with this, I would recommend speaking to one of my colleagues in our financial planning department who'd be happy to help. So going on to the calculation, the inheritance tax position is exactly the same on the first death. It's entirely covered by spousal exemption and there's no inheritance tax. However, on the second death, there are £2.8 million of assets subject to inheritance tax. We're able to use both nil rate bands because Henry hasn't used on his first death, and we've got Lorraine, so that's a total of £650,000. However, as the total estate now is over the £2.7 million, there is no residence nil rate band that's been entirely tapered to nil, and therefore there is 2.15 million that's subject to inheritance tax of 40%, which gives it an inheritance tax liability of £860,000. That's obviously a really substantial increase compared to the £320,000 they were originally paying before April 2027. So £540,000 increase. You can also see on the slide there that I've split out the inheritance tax liability between what's payable in respect of the pension and what's payable in respect of the death estate. The amount that's payable in respect of the pension can be paid from the pension fund assets. The amount for the death estate will need to be paid from the death estate. However, if we look at their assets, again, they've only got £500,000 of liquid assets to pay that inheritance tax liability. So how are they going to repay the remaining amount? They're going to have to sell assets. That's going to be the rental property, their home, things like that. But in order to do that, they're going to have to get the grant of probate. Inheritance tax on death is due for payment at the end of the month, 6 months after death. So in order to pay that inheritance tax liability in time, they'll have to receive the grant of probate and sold the property. Any inheritance tax that's not paid within that period starts being subject to interest. The interest rate is currently 8%, so it's quite a high rate to be paying. So given this change, seeing more and more clients that are being impacted by this, and a new strategy is needed given the changes, and more people are going to have to consider inheritance tax in the future. So I'm just going to hand you back to JP now, who has a poll for you.
Thanks, Charles. So it's time for our first poll. Hopefully the tech will work here. So I'm going to press the button. So the question is, will your estate's IHT liability increase from April 2027 when pension death benefits will be included in your estate for IHT purposes? So if I can just give you 10 seconds to press the button yes or no. Okay, there's a resounding result here. I'm going to publish that. So hopefully you can see 86% of you has said that yes, your IHT liability will increase from April 2027. This just shows the scale of this issue on the horizon. So hopefully we've given you the tools now to work out if your estate has an IHT liability. What I'd like to go on to now is highlight the options that you can consider taking to help mitigate this and effectively pass more of your assets on to your loved ones. IHT strategies, inheritance tax strategies, tend to involve a trade-off. Typically, strategies that retain greater access to capital have a lesser IHT benefit, and strategies that retain less access to capital have a greater IHT benefit. However, there is one exception to this rule. Rarely in life, and certainly in tax, can you have your cake and eat it. However, under certain circumstances, there is one of these opportunities in IHT planning where you can get an immediate IHT saving and also potentially retain access to the capital. This is only an option if you received a legacy and the date of death of the deceased, the person that passed you the legacy, was in the past 24 months of the last 2 years. In this scenario, there is an opportunity to redirect some or all of that legacy, if you don't need it, via a legal document called a deed of variation. That legacy can be redirected directly to an individual or a group of individuals or into a trust. There are a number of specific criteria that you need to meet to take advantage of this opportunity, and you should seek legal advice if this is likely to be an opportunity for you. Outside of a deed of variation, the two simplest strategies to mitigate IHT are spending and gifting, because both reduce your estate for IHT purposes. Many clients love the idea of spending their way out of an IHT issue, but the spending needs to be on things that don't have a value in the future. So things like holidays, for example, not things like classic cars or jewelry. The reality is that for many clients, they're used to their current lifestyle and their current pattern of spending, and they find it hard to change this. And for other clients, it's unlikely to fix the problem given the size of their IHT liability. So, assuming you can't fix your problem just by spending, let's now look at gifting strategies. Gifting strategies for IHT in general are all about moving assets from in your estate for IHT purposes. So on the left-hand side of this slide, around an imaginary inheritance tax wall to the right-hand side where they're out of your estate for IHT purposes. Typically, the tools to use as part of an IHT gifting strategy are surplus capital and or surplus income. Certain gifts of capital and income are immediately effective for IHT. They go straight across the wall or around the wall, and others take 7 years. There'll be more to come on this from Charles in a minute. You should only consider gifting capital or income that you are really sure you won't need in the future. So how do you work this out? How do you work out that figure? Rather than just putting a finger in the air and taking a guess, we help clients with some sophisticated cash flow software to help identify surplus capital and or income, which can then be confidently earmarked towards an IHT gifting strategy. We first forecast income versus expenditure to help understand when clients are likely to have more income than expenditure and vice versa. And that's what this picture is an example of. We agree with clients a number of assumptions, include inflation, longevity, and things like the need for long-term care in the future. Off the back of that first forecast, we then forecast when and how clients are likely to use their savings and investments long-term to meet their long-term income requirements. And that results in a graph like this. We run multiple stress tests. So things like, what if the markets go through, investment markets go through a stressful period now and again in the future? What if you require a long-term care in the future? If at the end of those stress tests, we do forecast surplus capital, as in this example on the screen here on the far right-hand side, this really is surplus that can be confidently earmarked to use in a gifting strategy. The sooner this position is known, the better, as in many cases, it does take 7 years for gifts to fall out of the estate for IHT purposes. If you don't use a mathematical approach like this that I've just described to your planning in this area, you do run the risk of possibly not giving enough assets away during your lifetime, and your estate ends up with a larger IHT bill than perhaps it needed to. Or on the flip side, you run the risk of giving too much assets away during your lifetime. And in that scenario, you could put yourself at financial risk. I'm now going to pass over to Charles to run through the range of IHT gift exemptions and also explain the difference between gifts into direct gifts versus gifts into trust.
Thanks, JP. And yeah, I'd definitely just like to say, I really recommend those cash flow forecasts. I know clients that have been looking to make gifts, and having that sort of visual representation in front of them gives them the confidence to sort of give away assets and cash, and know that they have enough for the rest of their lives. So I really think those are worthwhile. So looking at some IHT exemptions, first of all, there we've got the annual exemption, so that's £3,000. In addition to that, any unused annual exemption from the previous tax year can also be used. So that gives a total potential annual exemption of £6,000. Again, it's not a large amount, but making use of it every year can build up over a number of years. So there's also the small gifts allowance. This is up to £250 per tax year and per individual. It can't be used in conjunction with any other of the exemptions, and therefore if you give away more than £250 to an individual in a tax year, the small gifts exemption can't apply. It's typically used for things like Christmas presents and birthday presents, that sort of thing. So another exemption is gifts on marriage. The amount of the exemption depends on who the gift has been made to. So it's £5,000 if the gift is to a child, £2,500 if it's to a grandchild or a great-grandchild, and £1,000 to any other person. There's also an exemption for regular gifts out of surplus income. So this is quite popular at the moment when people are talking about pensions. People are looking to draw down on their pensions, increase their income, create surplus income, which can then be given away free of inheritance tax. There's no 7-year rule to worry about. The gift is immediately exempt. There are conditions to meet in order to qualify for that exemption. Firstly, the gift must be regular, so that could be weekly, monthly, annual, something like that. The gift must be out of income, so all your total income, less all your outgoings, less your tax, that whatever surplus amount you've got, that is your surplus income you can give away. The other thing to bear in mind is it must be the surplus income that is given away. You cannot, for instance, give away a piece of jewellery or a car in place of giving the income. It can't be a capital asset. And finally, the gift cannot reduce your standard of living. Therefore, if you go on holiday every year, you still must be able to go on holiday and keep doing that. So finally, any gifts you make that don't qualify for any of the exemptions have the normal 7-year rule. So that means if you pass away within 7 years of the gift, they are brought into account when calculating the inheritance tax due on your death. Can we go on to the next slide, please? Thank you. Another valuable relief is taper relief. There is a misconception with taper relief that it applies to all gifts, but taper relief only applies when there's inheritance tax due on the gift itself. This is where the gift is more than the available nil rate bands. So that's your own nil rate band and any transferable nil rate band available. The way taper relief works is it reduces the rate of inheritance tax on the gift. As it's shown on the table, the rate of inheritance tax is reduced by 20% after the first anniversary of the gift. It's reduced by a further 20% each year until the gift is exempt after 7 years. Another thing to bear in mind with making lifetime gifts is that you cannot continue to benefit from whatever assets you've given away. If you continue to benefit from those assets, they will continue to fall within your estate for IHT purposes due to the gift with reservation of benefit rules. A common example of this might be where parents give their property to their child, but continue to live in the property rent-free, in which case that property would continue to form part of their estate for inheritance tax purposes. So we talked a lot about gifting. There's obviously gifting to individuals, but you might also want to consider gifting to a trust. In terms of, what is a trust and what's the use of it? So a trust is an arrangement which allows the settlor, the person making the gift, to gift assets to the trustees, the people who have the control over the trust assets, for the benefit of the beneficiaries under the terms set out in the trust deed. So in terms of why you might want to use a trust, first of all, there are some tax advantages of using trusts. Thinking about the inheritance tax benefits first, they don't fall within any individual's estate. They fall within something called the relevant property regime. This means they're subject to inheritance tax every 10 years at a maximum rate of 6%. So that's obviously considerably lower than the death estate rate. Often these trusts are discretionary trusts, which give the trustees the control over the distribution of income of capital to the beneficiaries. This allows the tax-efficient distribution of income to make use of beneficiaries' personal allowances, basic rate bands, and things like that. Where an asset is gifted to someone, this is treated as a market value disposal for capital gains tax purposes. However, where an asset is gifted to a trust, it is possible to defer that gain that's arising due to holdover relief. That means the gain only comes back into charge when the trustees dispose of the asset. Going on to the second point there about control. Although the asset is given away and the settlor can no longer benefit due to the gift with reservation of benefit rules mentioned above, they can still be a trustee and retain control over those assets. This might be particularly helpful if they're looking to gift assets to a minor who might not be ready to receive those assets, or someone who is in financial difficulty or having relationship issues. It also allows the gift to be delayed until such time that the beneficiary is ready to receive those funds, because within the trustee still has the control, and it's only when the trustee is ready that those assets pass to the beneficiary absolutely. So in terms of protection of family wealth, trusts do provide a degree of protection on divorce and bankruptcy and that type of thing. I would recommend taking legal advice to fully understand the effectiveness of this. Trusts aren't perfect in that regard. However, they can ensure that wealth is kept within the family regardless of what's in the beneficiary's wills. The trustee will set out who the beneficiaries are, and those are the only people that can benefit from the trust assets, so it can ensure that wealth stays within the family. In terms of flexibility, as I've already mentioned, it does allow income to be distributed in a flexible manner. Again, the trustees also have control over the distribution of capital, and this can be provided to the beneficiaries as and when the trustees see fit. Therefore, it can be staged over a number of years and things like that. Trusts are also multi-generational, so often when referring to the trustees in the trust deed, the beneficiaries, in the trust deed, it will say things such as my descendants or my remoter issue, in which case assets can skip a generation, saving further inheritance tax. There are some downsides with trusts. They are more complex. There are setup costs with them, and they can be expensive in terms of ongoing running costs as well. So can we go on to the next slide, please? Thank you. So talking about the tax difference between a gift to an individual and a gift to a trust. So a gift to an individual is a potentially exempt transfer or a PET. These are only chargeable if you die within 7 years of the gift. A gift to a trust is a chargeable lifetime transfer, which is immediately chargeable to inheritance tax. If the value given away is more than your available nil rate band of £325,000, lifetime inheritance tax is due. This is charged at 20% of the value over the nil rate band, assuming the tax is paid from the assets within the trust. This rate is increased to 25% if the settlor pays the tax. Similar to a PET, any chargeable lifetime transfers within 7 years of death are brought into account and then subject to inheritance tax at the death rate of 40%. You do receive credit for any lifetime tax paid on settling assets on trust, but this cannot create a refund. And typically when they are set up in lifetime, it's done to not create a lifetime charge. So many people might be familiar with the 7-year rule that any gifts within 7 years of death are brought into account. However, the 14-year rule is far less common. This is where a chargeable lifetime transfer is made before a subsequent gift, in which case the earlier gift can still affect the inheritance tax position on death, even if it's more than 7 years before death. This is quite a complex area, and if you are looking to make multiple gifts, including gifts into trust, I would recommend taking advice to ensure you don't fall foul of any of the timing issues there. So I'm now going to hand you back to JP, who will run through some specific financial planning solutions.
Thanks, Charles. So I'm going to run through the range of financial planning IHT solutions available. This is a busy slide, So don't worry if you can't read all the detail. What it's designed to show is that there is a large range of financial planning IHT solutions. So there's a flowchart there and the solutions along the bottom. The ones for you to consider will depend on your personal circumstances and also depend on what tools you have at your disposal in relation to surplus capital or surplus income and the level of access you want or need to retain to that going forward. The range of solutions, the range from, on the far left-hand side, ones using surplus income, through to the far right-hand side, solutions using capital, where you need an income but no access to that capital going forward. You should definitely take advice when you're assessing which of the possible financial plan IHT solutions are suitable for your requirements, as choosing the wrong ones can be very costly and painful to unwind. I'm now going to go into detail. I'm not going to go into detail on all of the financial planning solutions along the bottom there, because we would be here till next week rather than finishing at 1 o'clock today. But I am going to go into more detail on one of these options. In fact, the one on the far left, that's where someone has surplus income and the use of a life assurance policy. So if you have surplus income, rather than just letting this build up in your bank account or your savings account, getting probably little return, and also increasing the estate, the value of your estate for IHT purposes, you could tax efficiently use some or all of that surplus income to meet the cost of some or all of your estate's expected IHT liability in the future by paying premiums for a whole of life assurance policy. In this type of planning, the policy should be held in trust. So the sum assured, that's the death benefit, will be paid out to the executors of the estate on proof of death. So that's at the point the death certificate is produced. Ahead of probate, probate is not required. So the executors would have the means to meet some or all of the estate's IHT liability without the need to fire sell assets. Premiums for life insurance are based on the sum assured, so the death benefit, and the underwriting decision, which is a factor of things like age, whether you're male or female, your state of health, and whether you smoke or not. Insurance companies compete for business in this area, so you should make sure you use an independent advisor for this type of work to be able to assess all the solutions on the marketplace. You should also take advice to make sure any policy that's set up is set up on the right basis and held under a suitable trust, because otherwise there is the potential that actually this planning could inflate your estate for IHT purposes. Another situation where life assurance can help as part of an IHT strategy is in respect of protecting against potential IHT over 7 years on a gift that qualifies as a pet. So in the example on the screen, we assume that someone's made a large gift, and the IHT liability on that gift, if you can see, starts at £200,000, and then it tapers down to zero over 7 years, as described by Charles in terms of the tapering. You could protect this reducing IHT liability by using something called a gift inter vivos policy, or you could use 5 separate term assurance policies with differing terms, all held under trust. Interestingly, we tend to find for the majority of clients, the latter option, the series of term assurance policies, turns out to be the most cost effective. So what about pensions? As I mentioned earlier, pension death benefits are currently exempt from IHT. So many people have been earmarking these as the last asset to use in retirement, as they've been sensibly using all other assets, all other savings and investments in their estate first. However, from April 2027, as I mentioned, pension funds will fall into your estate for IHT purposes. So you may want to consider changing this strategy and using your pension funds in the future towards your IHT strategy. In most cases, when you take benefits from your pension, you'll be able to take 25% tax-free cash. Then the residual balance, the other 75%, is taxed as income at your marginal rate of income tax, and that's typically used to buy an annuity or go into drawdown. So how could you use your pension benefits as a tool in an IHT strategy post 2027? If we scoot forward again 18 months and assume we're there in April 2027 and subject to the new rules, although you may not mathematically need to take any of your pension benefits, you could, if you haven't already, take your 25% tax-free cash and you could spend it. You could use it to meet your income need, for example. You could gift it. You could gift it directly or into trust, and you could start that 7-year ticking clock. Or you could take it and you could reinvest it tax efficiently in specialist IHT investments that qualify for business relief and are exempt from IHT after 2 years. Otherwise, if you leave the tax-free cash in the pension, it may be liable for IHT at 40% on death. In addition, you could also consider taking taxable income and using this as part of your IHT strategy. Now, this strategy is likely to be more attractive for clients over age 75, as although you'd pay income tax on the withdrawal from that part at your marginal rate, you could then gift the net income directly or into trust using that regular gifts out of surplus income exemption that Charles spoke about earlier. In that scenario, that the money gifted would be immediately out of your estate for IHT purposes and would save 40% IHT on death from this part of the pension. Alternatively, this taxable income withdrawn could be used to fund a whole of life assurance policy as per the planning I just mentioned. There could be some limited scenarios where taking these actions before April 2027 is sensible, but definitely a lot of caution should be exercised and advice taken, as you could potentially end up in a worse position in the short term by doing this. This is high profile stuff. And in fact, this article is just from the industry press reported this week. It was reported that pension withdrawals have increased 36% over the past tax year amid concerns around IHT and pensions. According to data from the regulator, the FCA, overall money withdrawn from pensions has surged to over 70 billion. Well, it surged to over 70 billion last tax year, and that was up from 52 billion in the previous tax year. We do expect this direction of travel, so withdrawals from pension funds, to increase as we get closer to April 2027, those rule changes, and then as we get into the new world. So it's now time for our second poll. Hopefully you can see the second poll. The question is, are you planning on taking action over the coming years to help to mitigate your estate's IHT liability? I'll give you 10 seconds again to choose yes or no to that question. Thank you. So I'll publish the results. Hopefully you can see the published results. The result is 83% of you say that you do plan on taking action over the coming years to help mitigate your estate's IHT liability. Just shows just how high profile this area is, particularly given the changes that are coming in the future years. So, in summary, we suggest you do the following. First of all, do the maths. That is, calculate, does your estate have an IHT liability? Hopefully, we've helped today your understanding of how to go about doing that calculation. If the answer to that question is yes, then move on to question number 2. Do you want to take action on this? So that's really talking about, do you want to pass more of your assets to your loved ones in the future? If the answer to both of those questions is a yes, then our recommendation is to take advice. And that's because, like I said right at the start, IHT is complicated. It's getting more complicated, and everyone's situation is different. There is no single one-size-fits-all approach. If you are going to take action and take advice, if you don't already have professional advisors to help you in this area, we are here to help. So We offer an initial meeting without cost or obligation to discuss your IHT options and calculate your IHT position. And if you'd like to take up this opportunity, please contact us on one of the email addresses on the screen. There's no need to rush to scribble those down now, and we are going to email them to you after this webinar as a follow-up. So that takes us on to questions. Have we had any questions, Charles?
Yes, we have had a few questions. I'll just go on with the first one, if that's all right. It's about making regular gifts out of surplus income. So someone's asked about what sort of record keeping, what sort of evidence should they use. My suggestion would be to use the IHT 403 form to record the gift. So that's the form that your executors will need to submit to HMRC once you've passed away to claim that relief. So if the record of the gifts are kept in that format, then that seems a sensible way to keep it. In addition to that, we generally advise clients that are looking to make that exemption to write a letter at the time to whoever is receiving the gift to explain, to demonstrate that intention to make the regular gift. So I hope that's helped, and please do come back to me if there's any further questions on that one. So I think there's also a question for you, JP. So what are the specialist IHT investments you mentioned you could invest the tax-free cash in?
So that's a good question. So if you have surplus capital, or as a result of taking perhaps tax-free cash out of the pension in the future, you have surplus capital, there are specialist IHT investments which qualify for business relief. So if you're not already using the business relief exemption, which is typically in relation to owning business assets, that exemption is currently unlimited, and that's the exemption that John spoke about in the first webinar, will be limited to 100% relief up to the first £1 million from 2026, and 50% on the balance above that. If you're not using that valuable relief, there is the opportunity to invest in these types of specialist investments to take advantage of that. The opportunity is to invest in shares in unquoted UK companies. So specialist providers select companies that they expect to qualify for business relief, which is a government approved relief from inheritance tax. Providing these specialist types of investments have been held for 2 years and also held at the time of death, they can be left to the beneficiaries up to 100% inheritance tax free. These types of investments come with a number of risks, as you'd expect, given the very beneficial IHT treatment. So the type of risk to bear in mind are they're classed as high risk investments. So there is certainly capital at risk investments. The capital is fluctuates, the capital value fluctuates and tends to fluctuate more and can fluctuate more than investments in standard investments because of the nature of being in unquoted shares. Being in unquoted shares, they can also be less liquid. That means there is the opportunity to access capital out of these investments. You don't give up access to them, you're not giving them away, but they are typically less liquid than standard investments. And in times of stress, particularly, it can take longer to access capital out of these types of arrangements. There is also the risk that the tax rules could change on these types of investments in the future. And the investments need to qualify for business relief on death. Now, awkwardly, HMRC only conduct a business relief assessment on these types of investments on death. So it's only at that point will it be confirmed whether these types of investments that have been held will qualify for business relief at that point. So these are specialist. They can form a valuable part of many clients' inheritance tax strategies. They are higher risk, and therefore we strongly recommend you take advice if you're interested in considering action in that area. Hope that answers that, Charles.
Yeah, brilliant. Thank you. I mean, on a similar line, someone's asked whether the ITS schemes, which are those types of business property release investments you were talking about, are affected by those changes to business property relief. And yes, I mean, assuming they're qualifying for 100% relief, they will be affected by that new £1 million allowance. So going on to another similar question that someone's asked about, is there a monetary limit on the surplus income rule? There is no limit on that. So regardless of how much surplus income you've got, it is possible to meet that exemption regardless of the amount. Another question that I've had in for you, JP, is I expect my property and pension will increase in value over time. Can you increase the cover on a life assurance policy to reflect this?
So that's another good question. The simple answer is potentially yes. So at outset, if you set up a life assurance policy to meet some or all of an expected IHT liability, there is the option to include that cover increasing over time. Though that increasing option is only available at outset, and it's set at either an inflation figure, so typically RPI, or a fixed percentage, which depending on the provider is typically somewhere between 3 and 5%. So if you think your IHT liability is going to increase with your pension fund you mentioned and property increasing over time, and therefore your IHT liability is likely to increase over time, there is the opportunity for the sum assured, the death benefit, to increase over time, linked to one of those increased options. Clearly, it does have an impact on the premium that's paid in the future. If the sum assured is going to increase, then the premium will increase correspondingly over time. If someone's IHT liability all of a sudden changed, so if all of a sudden their assets increased greatly, there is the scenario. Some providers do provide an opportunity to increase life assurance without the need for new underwriting, so not new medical underwriting. It is limited. The number of providers who offer that opportunity is limited. But in that scenario, you say, for example, for example, pension, you've got life insurance in place and pensions come into the state in 2027 and inflates your estate as a result, and you want to consider increasing your life cover. In that scenario, it is limited when you can increase the sum assured. It typically is scenarios where at outset, there wasn't an increase chosen. It has to be level benefit at outset. The benefit, the underwriting at outset would need to be on standard terms, so it's not possible if you've been rated at outset. And typically, you need to be under 70 at the point you take up that opportunity to increase the sum assured. It is limited. The providers in the market do limit their opportunity in this space, and that's typically limited. The increase in the sum assured is limited to the lower of half the original sum assured, or £200,000. So there is some flexibility. In answer to that question, there is some flexibility to increase the sum assured on whole of life policies, whether that's at outset or potentially in the future.
Thanks, JP. So I have a few more questions. Might not get to all of them today, but we'll look to get back to you if not possible. So got another question there. If someone makes a gift of, say, 100,000 out of capital and dies within 7 years, does the tapering not actually apply, as no tax would be due on the gift? So that is correct. So if you make a gift of £100,000 and you haven't made any other gifts within the last 7 years, that will first use up your nil rate band. So it will mean that instead of having 325 of nil rate band available against your death estate, you'll only have £225,000. So it will just increase the inheritance tax due on the death estate, and tapering relief won't be available. I think that is a common misconception about tapering relief, that it applies to all gifts. Another thing to bear in mind is in inheritance tax in relation to gifts, is that if there is inheritance tax due on the gift itself, it's payable by the recipient of the gift, not from the death estate. So that's, again, something that not everyone is aware of. I think that's probably most of the question. There are still a few more if we've got some time, JP.
Yeah, you want to choose another
sure.
one or two?
Yeah, not a problem. Does the initial transfer of APR or BPR assets to the surviving spouse lead to a 20% tax liability over the initial £1 million zero rate band? So where you leave assets to your spouse, they qualify for spousal exemption, so APR and BPR aren't relevant. However, the thing to bear in mind is that £1 million allowance where 100% APR or BPR applies is not transferable between spouses. So unlike the nil right bands we've been talking about, the APR and BPR allowance isn't transferable. So if you did leave those qualifying assets to a surviving spouse, then that £1 million allowance would be wasted. So again, that's where sort of ensuring you have up-to-date wills reviewed to ensure that allowance isn't wasted. Brilliant.
One more, Charles, if there is.
Any more? I'm just having a quick look through. So someone's asked whether their SAS will form part of their estate from April 2027. So SAS is another type of form of pension scheme, and yes, unfortunately, SAS will be subject to inheritance tax on death from April 2027 as well.
That's
yes,
right. I mean, yeah, all defined contribution arrangements, all of those pension funds that typically have a fund value rather than a pension benefit like a final salary scheme, that's not included. But pension funds that have a fund value like a SAS, a SIP, personal pension, group personal pension, etc., all of those will be impacted by these changes in April 2027.
Yeah, absolutely. And then just I think another question we've had is the annual gift allowance per child or for all gifts? So the annual exemption for gifts of £3,000 is in relation to all gifts, and that's per tax year, and it's allocated to the earliest gifts in priority. So the earlier gifts you make in the tax year will use up that £3,000 exemption. Okay.
Excellent. You mentioned it in passing, Charles. That £3,000 allowance doesn't sound a lot, but if it's used year in, year out, let's say over 10 years, for a couple, that's £60,000 that they've gifted immediately outside of the estate for IHT. So effectively, over 10 years, say 40% of £60,000 using that allowance, that's £24,000 worth of IHT savings. So lots and lots of actions around IHT are around taking actions, sensible actions year in, year out, rather than one-off boom action. Very rarely, as I mentioned in passing, do people take one action and it fixes the problem.
Yeah, absolutely.
Good. If there was any more questions in there, we will come back to you as a follow-up. I'm just conscious of time. So just wanted to share a final reminder of the last 2 webinars, which are coming up in this series of 4. So they are coming up towards the end of the month. Also to say a recording of this webinar will be emailed to you with our contact details if you'd like to get in contact, if you'd like to have a conversation about this, about your personal affairs. That will be coming after today from our marketing team. So a final thank you from me and Charles for joining the webinar. We hope you find it interesting, useful, and you enjoy the rest of your day. So thank you very much and goodbye.